Good afternoon, everyone. Welcome to the QOZ 3 initial webinar. I believe this is the first one. It might be the second, actually. That's a disclaimer. We're required to share that with you. So please refer to that if you want to read it more. My name is David Scherer. I'm co-founder, co-CEO of Origin Investments. I'm really excited today to be joined by Kyle Verhasselt, who's been my team member now for 8 years. Kyle came over from GE Capital in 2015. Correct me if I'm wrong later, Kyle, but I think that's correct. Interesting story about Kyle. He's a triplet. He was born and raised on a farm right near Cheesehead country. So if you're a Chicago Bears fan, he's definitely in the enemy camp. I'm a 30-year resident of Chicago, so we certainly bet on games, and I have not had a good track record with my friend Kyle for a very long time. I need to keep my day job. All right, so we're gonna get started. The goal of this, because we thank you first of all for your questions that you sent in prior. The flavor that I got from the questions, number one, we need to better educate you about the benefits of qualified opportunity zone investing. Many of you aren't currently investors in our fund 1 or 2. This is our third fund in that area. And then secondly, there's some market level questions and some deal level questions. I intend to have the presentation cover all of the questions emailed in prior. If they're not covered or you don't think they're covered in detail enough, please ask us the question again in the live Q&A box. We're going to have about 20 to 30 minutes of live Q&A. And candidly, we won't leave the webinar until every question is answered. We're committed to transparency. So if you keep asking questions, we'll keep answering them. And so the last line of defense is my own email, david@origininvestments.com. If you feel like you'd rather have a personal dialogue, send me an email and I will either answer the question or I will refer it. We have 57 team members at Origin, and I know that we can get you any level of detail that you need. So with that, let's get started. I'm going to be about 15 minutes, and I believe Kyle as well. My intent is to have this webinar be about an hour in total. First slide, please. Qualified opportunity zone investing, and it really should be viewed as a long-term partnership. So if you're considering it, the first thing you should think about is what is the business risk associated with partnering with this manager or this company? Origin has been around now for 16 years. We were founded in 2007. What we're most proud of is the fact that we're a top decile fund manager. That's actually for the last 7 years, identified by Preqin. And they essentially sort managers by vintage and strategy. And so we are a multifamily only manager, so we're compared to other multifamily only managers. If you look at our qualified opportunity zone ranking, it's even more impressive. We are ranked 12th out of 754 opportunity zone fund managers. In terms of the Preqin ranking, we're ranked 10th out of 249 global private real estate managers. And that includes firms that are bigger than us, smaller than us. I won't name names, but many of the household names that you've heard of were ranked significantly above. And we're really proud of that. In terms of our average gross IRR on exited deals, and that's on 42 deals at this point, it's been 28%, a 2.2 average equity multiple on exited deals. In terms of scale, this is our third qualified opportunity zone fund. The first fund was 275 million. The second was just over 300 million. That math doesn't quite add up to 564, so I must be slightly wrong. But you get the idea. They're both similar in size, and that makes us one of the largest qualified opportunity zone managers in the country. In fact, we're top 2% in terms of opportunity zone equity raised. A lot of people get comfort in the fact that myself and my partner and co-founder, Michael Episcope, remain our largest investors. And we're significantly invested in Qualified Opportunity Zone 1 and 2, and we will be in Qualified Opportunity Zone 3 as well. We have 75 million of our capital invested alongside you. So the outcomes of these investments are quite important to us as well as you, but candidly, even if I wasn't, I view my role as a fiduciary as more important than anything else I do here, including my own capital. I'm more actually concerned about yours. Next slide, please. One of the questions we had prior, so I want to address this, was getting a 10 to 12% net IRR seems low for development. That was the question. And I actually agree with you. But the interesting thing is this investment isn't just a development investment. And so if you think about an opportunity zone investment, it's a 10-year investment minimum. You have to have your capital invested for 10 years in order to get the elimination of taxes, which is candidly unheard of. I've never seen it like it. There's tax deferrals I've seen, but I've never seen an actual elimination of taxes. It's new, and it's very compelling. And so when you look at this investment, you look at it really as two investments. And that's why it's really important to have a manager that has proven their ability to take in money and protect it and grow it over long periods of time. And we've done that. The first 5 years are a development phase. And in that 5-year period, you're thinking about development returns, 15 to 20%. But the next 5 years, you have a cash flowing asset, a very low risk asset. And typically that gets 8 to 9%, 4 or 5% in cash flow to investors and 2 to 4% in appreciation. And so you're really looking at two completely different risk return profiles all within one fund. And you need a manager that can both execute in development. In the case of Origin, we have 14,000 units in development right now. We're one of the larger developers in the country. We've proven we can do that. Both the scale of it, but more importantly, the returns have been quite high. But then you also want a manager that has a proven track record of operating and owning real estate, which we also have, and value adding real estate. Because interesting enough, if you hold a building that's brand new, in years 4 and 5, you're probably going to be doing value added elements to maximize rents. You might be adding a backsplash, you might be redoing fixtures, things of that nature. And so we're experienced at that as well. And it's something to keep in mind. So the 10 to 12% is actually a net IRR. Number one, that's net of all fees. So that's what comes to you. And it's a combination of these two phases, the development phase and the core phase. And then what I would I'd like to rather focus on the net equity multiple, because not only is that significant, if you invest $1 million, you're getting out 2.2 to 2.5 over the life cycle of this investment, but it's also tax-free. And one of the things that's really interesting is not only is it tax-free, but the cash flow that you get in years 5 through 10, or even beyond, if you choose to stay in longer, is offset with depreciation. So you're really not getting taxed, even though you're getting cash flow out of the building. And then there's no catch up of that depreciation because there's no capital gain at the end. So it's essentially free depreciation in addition to the forgiveness of the ultimate capital gain tax. If you have questions about that, we can cover that. It's a little bit nuanced, but it's important. Next slide. So I mentioned this on the last slide, but it is a combination of two different risk profiles and investments. The first is a development. QOZ law requires us to improve the property by the amount that we pay for the property, which generally means you need to develop a new building. So this fund will be investing capital in 2023, and there's generally, depending on construction type, a 3 to 4 year period where we build and then rent that building to create cash flow. And so here on the timeline, that's 23 to 27, that's quote the development period. At the end of 2026, that's when you're initial tax deferral on your capital gain is due, but it's payable in 2027. So 2026 tax is payable in 2027. That's when you'll need to then pay that capital gain that you deferred. It also begins the refinance period where we'll be refinancing off the construction loan into permanent debt. And this is a long-term hold, so we want to pair it with long-term fixed debt. And then you'll also be getting your dividends, which are from that sort of 27 to 33 period. We don't represent here on the timeline what those dividends or what that refinance will be, because it's a function of both the strength of the market at the time, the valuation side, but also the interest rate market. And we don't know where interest rates will be in 2027, so I'm not comfortable showing how much levered yield will be there. Historically, levered yield has been 4, 5, 6, 7%. But we're in interesting times right now where it's difficult to know where inflation and the federal funds rate will be in 2027. I will say, however, if you look at the last inflationary period, which you have to go back a long period, so you're talking about the late 70s, early 80s, real estate, and in particular multifamily real estate, was one of the only assets that you could make money in during a very difficult investment period. So if you want to draw back to assets that did well during that period, there's very few. And this was one that actually bucked that trend. Next slide, please. I was remiss on the last slide. Go back, Jeff, because this is an important point that I want to make. In order to get the tax elimination, you need to hold the asset for 10 years. The program doesn't expire until 2047. And so you will have the option in QOZ 3, you can get out of your investment and convert to cash if you need liquidity at that point. I don't intend to do that. I'm not going to do that in QOZ 1 or 2 either, because what's happened is you can hold it all the way to 2047 and continue to accumulate gains that are tax-free. And so essentially you've created an IRA that is accumulating value and compounding. And when it's done, it's tax-free. And so that's a very unique feature that you should think about. Obviously, your own liquidity is a consideration. And so if you want to get out, we will make sure that you can get out, and you will have that option starting with that 10-year period lapsing. But I believe many of our investors probably will opt to stay in because it's very difficult to replicate what's happening within this sort of tax-free zone. Next slide, please. Origin, like I said, has been around since 2007. Kyle, who's joining us, is very indicative of this strategy. First of all, we only invest in multifamily. Secondly, we only invest in what we deem our growth markets. We characterize that as the Southeast, Southwest, and Texas. And we have offices throughout these markets. And Kyle will get into more detail about the benefits of having offices. It yields much deeper relationships and better understanding of the cities and where they're growing. And you'll see that through our deal pipeline through QOZ 3. It also yields much better connectivity to the city itself and the people that are involved with entitlements and tax incentives. And you'll see that really is an underpinning of our overperformance as well. Kyle runs our Nashville office. He lives in Nashville. We also have offices in Charlotte, Dallas, and Denver. And many of our investment professionals live in other cities, in smaller offices. Atlanta is an example, Austin, Texas is an example, et cetera. And so boots on the ground is a huge differentiation between us and our competitors. I don't think it's arguable. If you told me our headquarters is in Chicago, in fact, it is. That's where I'm sitting today. That's where our data science is. That's where our accounting teams are. That's where our analysis is. If you told me that's it's just a different model. We all sit in Chicago and then we fly into these cities. To me, that's not different. It's worse. I don't think it's arguable that we have a better model than our competitors because our people live and work in the cities we invest. And because it's not arguable, that's why we set it up that way 10 years ago. So we are true experts in these cities and these areas and regions because we live there and have the infrastructure there. Origin Multilytics, I'm going to get this, and it has its own slide because it should, but we believe that we have the industry leading machine learning for rent predictive analytics. We've been building this for 3.5 years, and I will cover that a little bit deeper on the next slide. We already covered target fund distributions. Again, there's a development period. There's a lease up period. That's years 2 to 4, as you can see here, depending on construction type. And then in years 5 through 7, really 5 through 10, that's your core hold, which will include a refinance and levered yield on equity as we're managing a cash flowing building. Once we get through that full 10-year period, you'll have the option of staying in longer if you want. Again, tax-free accumulation, and importantly, depreciation that offsets your cash flow. So you'll not be paying taxes during that hold or when you sell the building, which is quite unique. Or you can opt to get out and get your cash out at that point in your return. Next slide. Multilytics, I mentioned. This is a platform that takes in over 3 billion data points every month. Right now, it's in excess of that because we figured out a way to scrape websites for even more free data. And so we have a data science team that has figured out what are the most important variables for predictive rent growth. And importantly, over the last 3 years, it's been step functions better than anything that you can license in the market. And so it accurately predicted the high rent growth of 21. It accurately predicted the high rent growth of Q1 and Q2 2022. And importantly, accurately predicted the leveling off of rent growth in Q3 and Q4 of last year into Q1 of this year. So we're incredibly proud of this. And it's proprietary to Origin. We don't intend to license it, share it. However, Kyle, you can speak to this. We do let some of our development partners use it because it actually works at the address level, which none of the competitive products can do. They only work at the zip code level. We can actually use this to determine where rent should be at a given moment in time, and the growth rate over a year, 2 years, 3 years, 4 years, 5 years, and it's been incredibly predictive. So it doesn't make decisions for us, but it's a huge tool we use, and it permeates everything we do. I mentioned before, we have 14,000 units in development, so it's very integrated into those decisions, but we're also very active in multifamily credit, and we use it very much there as well. Next slide, please. On the investment management side, again, I mentioned we have a development phase, and then we have an ownership operating phase. We call it the core phase. We're very proud of that team. They actually work throughout the process of both development and operations. But we have a growing team, 9 members at this point, dedicated towards execution of business plans. Importantly, we were ranked the #3 best operator in 2022 out of 68. And in terms of Google score, if you think about when you're leasing a building, if you don't have a high Google score, no one's going to go to your website. It's the beginning of a search process. We had a 23% increase in Google score last year. This is indicative of how we manage and view the world. We have benchmarks, but we also compare ourselves to all of our competitors all the time. And so if you look at the overall Google rating, we were 4.2, that's out of 5, and the breakdown is there, 5, 4, 3, 2, 1. And the industry average is 3.8. So we'll constantly try to improve that. But the industry average includes, some of the, I won't name them, but some of the household names are included in that average. we're doing a better job than others, because there's no way to have high ratings without having a quality physical experience and service experience. There's no easy way to a good rating. It has to be through quality. And I believe that's my last slide. I'm a little over, but not much, Kyle. I think if you hold a 15, we're right on schedule.
Awesome. Well, thanks, Dave. And looking forward to seeing if the Packers continue their dominance over the Bears the next 2 decades with Jordan Love.
Yeah, we'll see. I like Fields against Love. Finally, I think we have a chance.
Awesome. As Dave was mentioning with Origin Multilytics, really getting down to the asset-specific location. And real estate, there's a lot on this slide, as you can see, mentioning all the kind of the top growth markets in the Southeast, Texas, the Southwest. But really, real estate fundamental 101 is location, location, location. And the benefit of QOZ is it was based off of the 2010 census tracts for income. And so what we at Origin as deal professionals, and we're sourcing opportunities, we look for deals that we would do, whether it's in an opportunity zone or not. And so we're not looking for the QOZ in its truest sense, but something where we would want to live, work, go out to a restaurant and feel comfortable. And so that's something we're really focused on. That's something that when we drive markets, we get the feel, but it's also supplemented via our Origin Multilytics platform and knowing where to spend time, as well as continually increase allocations in certain submarkets. One of the other differentiating things for us as a fund manager in the QOZ space is we use the same discount rate that we would use as our conventional market rate, you know, as a growth fund 4 deal or as a build to core investment in our income plus fund. And so we don't take into account the tax benefit you as an individual investor gets. And why that's important is if we would take that benefit and gross that up, we may push ourselves to do a more riskier deal that if something were to go sideways, the deal would be in more jeopardy and your position. So we look from the same lens, which is very important. Also, we could go on about a few examples here, but to call out a few, Colorado Springs, we look for deals with unique advantages. And this is at the property level, but Colorado Springs, their downtown, and this was many years ago, set up a district where they were looking for X amount of units that could be developed and receive a tax benefit. I believe it was up to 2,000 units. Here, you could get a 75% tax abatement for 15 years if you met the criteria for the program, which we did. And so that kind of speaks to a huge edge in cash flow opportunity down the future and at the deal level and investments we're looking. Houston, we received a $9 million TIF financing incentive for that project. And then kind of speaking just overall for being local, boots on the ground, living in our markets. We're not just a group from Chicago that flies in or New York and then is out. We live in our local markets, which presents unique opportunities on deals, first looks, calls where you can go meet somebody for lunch that day or tour a site and give quick feedback. An example of deals like that in Nashville, Edge Hill Commons, that's a deal located in arguably one of the best opportunity zones in the country. It's no coincidence that I'm sitting in an office in the Gulch right now, which is a mere 5-minute walk to our site. We can literally see progress on the site once we start construction. But I think it's also representative of when our team comes into town or people we're doing business with, we recommend they stay in that area because it has some of the best hotels and then access to restaurants and other type of amenities for folks. And most notably, we're increasing our team down here, and one of our new team members lives into a comp that was just built pretty much adjacent to this property within a 2 to 3 minute walk. So I think that speaks volumes to the type of location we're investing in. Similar type of thing, my colleague Dave Welk, who lives in Charlotte. We have one of our first opportunity zone deals was in Noda. This is a multi-phase project where we'll build 1,000+ units. And if you would ask anybody or bring up the name Noda in Charlotte today, it's known for a similar type of thing. It's got a lot of energy, breweries that people go to, restaurants, and it's really not seen as gentrifying, it's seen as the area to be in. And so those are some examples of deals and opportunities that we really look throughout the country. And these don't just happen overnight. These are year-long relationships where we talk with developers, different folks at the city, and understanding programs in place that we can get an edge for fund and investors like y'all. Next slide, please. This pipeline overall is representative of a few of the common themes that we just touched on. One of those being, local relationships matter. And so, for example, the infill Nashville deal, that's a deal located, it's actually with an existing partner. We're closing on a deal in Austin with that is part of the PFC program, which is another tax advantage program at the deal level, specific to Texas only, that my colleague Phil Schuholtz has done a great job wrapping his arms around and getting us a good pipeline of deals there. But the specific sponsors based in Nashville here, they're working with the city of Nashville, given their deep expertise in LIHTC product and mixed income, as well as market rate, to create a mixed income tax pilot where there'll be some tax saving benefits down the road. So they're working, writing that bill with. We're also talking to them, incorporating any feedback into that specific bill that could be beneficial for the deal and long-term the city of Nashville overall. The other thing about these opportunities too, I think one of the things Dave mentioned earlier is it's no coincidence every opportunity zone fund that we have is around the same size of 275 million to 300 million. It's because that's where we know we can execute. But most importantly, it's about finding the best deals in the market and the right deals versus doing all of the deals. And so that's representative of the total size of the fund, where we feel the sweet spot is in being able to find the best deals. A lot of these opportunities, we'll get into a few case studies as an example, but we've been talking with developers for 2 to 3 years, providing input on how we would like to see the deal structured, or what it would have to take for us to be interested in the deal. And lastly, of these opportunities, I think one of the unique things here is 50% of these are already with existing partners that Origin has developed assets with, that we consider a tier 1 sponsor. We have a good working relationship with, we've executed product on and developments with, and then a handful of the other deals are with other developers in the area that we classify as a top tier developer and want to do business with, that aligns with how we think about deals, how we think about risk, and most importantly, they're good people and culture that we know will do the right thing at the respective time when is needed. Next slide, please. So Fund III pipeline deal, this opportunity is Anton Ballpark. It's an opportunity based in Glendale, which is just in the western suburbs of Phoenix. This is an opportunity we first saw about 3 years ago. So again, deals take a long time to put together, both working through city zoning, planning, entitlements, but also when they come to us from respective development partners as well. We've talked about this deal at our investment committee probably no less than 4 or 5 times throughout the years in various progress updates. But one of the unique things about this deal is when it originally came to us in 2021, that was in a different market environment when land prices were higher. They originally asked for a $15 million markup in the land, at which point the economics didn't make sense for us. We loved everything about the deal, but that and the current programming, which we'll get into. But so we held firm in our position. And now circling back 3 years later, we're in conversations on the deal and the opportunity with no land markup. Another unique thing about the deal here is originally it was 490 units, all as one phase. And that is one phase, is just a very, very large project, both from just getting financing purposes as well as doing it all at one time and worrying about cannibalizing yourself on lease up. And so we talked about doing it in multiple different phases through a bunch of different iterations with the city of Glendale. They talked about adding some more density, which they're able to get to increase to 490 units. And most importantly, we look for these projects where we can have a blend of unique product type to cater to different renters. And so this project fits that bill. Phase one will be about 279 units of traditional 3-4 story surface park garden. And then approximately a year later, there'll be about 220 mix of single family cottages and townhomes that will appeal to renters in this area. This area kind of checks the box as well when we look at demographics, the ability to pay from individuals. This specific deal, the demographic household income is 30% above the Phoenix MSA general income. And so we really like that component as we're looking at building projects. And then it's just got a diverse economy in and around this area. 4 of the 10 top hospitals in the state of Arizona are within this Glendale area. And then you have a good use of logistics in and around the area. And then amenities like 2 million square feet of retail. And if you're into baseball, the Cincinnati Reds and the Cleveland Guardians have their minor league affiliate teams around the corner from here, hence the name Anton Ballpark. So next slide, please. Similar theme on this opportunity. This is a deal in Charleston, an opportunity my colleague Dave Welk, who's based in Charlotte and covers the Carolinas for us, originally presented over a year ago. This opportunity, when presented the first time, so this is based 20 minutes north of downtown Charleston. The unique appeal to this deal is you don't have the high cost of living that you do on the peninsula, but you have the same charm being in low country. This is right 2 blocks off of the town center in Somerville, which is a quaint little town. Got a bunch of restaurants and shops, good walkability in the area. When this deal was originally presented, it was presented as 490 units. So similar theme as the deal that we just talked about in Phoenix. Our recommendation was concern on a lease up, having that many units at one time, and then also looking at back end liquidity on overall total deal size when we're looking at exiting, how can we best position it to maximize the buyer pool. And so our recommendation was to split the deal up into 2 deals, a phase 1 and a phase 2. The phase 1 that they reprogrammed the deal will be approximately 300 units with a 175 to 200 unit phase 2. Also, Dave mentioned we have 14,000 units under construction, with a lot of those being in the Southeast. When we were looking at the overall hard cost budget relative to what we were achieving in the market, we realized that there is some areas where we could achieve cost savings to the tune of 5%. And so we pointed out those line items and recommended that we would not move forward with the deal unless we were to achieve 5% total in cost savings, which also coincides with our minimum discount rate. And then lastly, given our talk and recommendation on making into multiple phases to make the project more feasible up front, as well as more optionality on the back end, we asked for co-GP participation as well as being the LP. What that means is the team, our investment management team, our acquisition team, spends a lot of time up front with them, making sure programming's right, recommendations on cost savings, and we want to be able to get paid for that benefit we're adding to the partnership. So we were in negotiations on a co-GP structure and getting some of the development fee and components around that. And the last unique edge that this deal has is the debt on this opportunity. So really since Q4 of last year, the credit markets have been really volatile and really tight on the construction lending side. Luckily for Origin, we have a lot of deep relationships and we're known as a top tier sponsor out in the market, which that capital is generally reserved for groups like ourselves. In this instance, the sponsor was able to tie up a debt term sheet with a really well-known local regional lender at 57.5% at 6% fixed rate. And so that helps provide significant edge in the deal in today's current environment. So those are kind of unique ways on just overall deal positioning. We've been talking about both these deals for 2 to 3 years now and continuing to build the relationships and most importantly, show the value we add as a partner in these deals.
All right, Kyle, thank you. We're almost right on time. We're good. I'm going to take over the summary of terms and then we'll jump right into Q&A. But thank you for taking us through the deals. I think it really makes it much more tangible when you take the concepts and show actual deals. So the summary of terms, it's a repeat of all the other, the Fund 1 and Fund 2. And so the annual management fee is 1.25% of net asset value. Minimum investment is $50,000. You don't need to be qualified. You just need to be accredited to be a partner in this fund. We don't have any committed fee. So oftentimes in funds, you pay a committed fee for us to look for assets. We're not asking for that. We do charge a 0.5% project level fee when we actually get it sourced and capitalized and break ground. And so in our mind, that's much better than a committed fee because we're essentially taking all the risks and all the work and cash flow getting to that point. And then the performance fee is 15% over a 7% preferred return. The market standard and performance fee is 20%. I'll just be very candid about that. We are below the market in terms of fees in aggregate and certainly in the performance fee area. But I want to stress value, not fees. I think we're also better at doing what we do than others. And that's really where you're gonna benefit here is we're a very good manager, but we're also only charging 15% performance fee, which is below market at that point. That's the fees. And if you have any other questions about fees structure, David at origininvestments.com, and we have 3 people on our legal team. Happy to have you interface with them or anyone on our investor relations teams as well. So with that, we're gonna jump into Q&A, and please continue to send in your questions. But the first question I want to cover, and this is and Kyle, I think we both should cover this because I want to hear your own answer too. But this is an anonymous question. And the question is, we get this a lot in different forms. One of the forms we get it is, hey, are there good QOZ deals left? And Kyle addressed that in his presentation. The reality is, yes, there are, because a lot of the deals that we've been looking at for 2 or 3 years are still out there and they're going into this fund because they were reinvented. And oftentimes there's a tax incentive now that we have that maybe we didn't before, or there's a $15 million landmark markup that's been waived. So obviously that increases the deal returns quite a bit. So the short answer is yes. The next question we get a lot is, do you have lower standards for returns because there's so many interesting tax savings here? And the answer is absolutely not. So any deal we look at, we're looking at trying to get a 1.9 to 2.0 multiple over 5 years on our money. And everything that we do is a giant equation. It's very complicated, but it's solving for that. And that's true whether we're in a qualified opportunity zone fund or a market rate fund. We have 2 different funds now that do market rate deals, Income Plus and Growth Fund 4. And by the way, QOZ, all of our funds benefit from those funds and vice versa, because we're so large in what we do because we have different forms of development. And that makes us better, both at executing development, but it also gets us more deal flow. When you're active in a market, you start to get first call. and we get first call because we're active. It sort of feeds on itself. We also have an enormous deal pipeline, and I'm going to kick it back to Kyle for this. Kyle, how many deals, you're just covering Nashville and our Florida markets. How many deals are you looking at a week and per year? And you're one of, 5 deal officers.
Yeah, I mean, we receive 50 plus deals a week. Out of that, there's half of those are not even deals that fit our general parameters. And then out of that 25, half of them maybe look interesting where it could meet our minimum cost of capital based on an early look or understanding of the location. Being locally where it's like you want to be on this side of the highway versus the other side, and that could be a significant discount. And so we're seeing a lot of opportunities. I think the thing that often gets lost about, and when QOZ first came out, was development deals, design, entitlement, getting permits from the city. Takes a long time. What used to be 12 to 18 months now is 24 months kind of at a minimum. And a lot of these projects in areas, there have been larger master plan communities that we're in conversations on multifamily specific use pieces of that. So like I was just down in Tampa the last 2 days and we were talking with a large developer about doing a multifamily component on one of their phases. And they're in talks with big 4 accounting firms for 500,000 square feet of space next to it and stuff like that. And similar story, my colleague Dave Welp in Charlotte is part of a big mixed use deal that takes time to put together with the city.
Yeah, so I would tell you that at investment committee, which we meet weekly, there are 2 to 4 deals presented a week. And so that's 100 to 200 deals a year. However, that's just the ones that get to the bottom of the funnel. And we've spent months in diligence and underwriting and staff time to get them to that point. The funnel is thousands of deals. And most of the deals that we see are either quickly thrown out or we find out relatively early on that they're, sort of building to a 5.2 to 5.5 cap. And that's 95% of the deals we see. We're trying to build to a 6 cap. We want that extra 10 to 12% margin. And those are the deals that get through. And so look, there's plenty of deals getting done. And back to Kyle's point about having a fund that's too big. If we had a really large fund, we'd have to let in these 5.5 return on cost deals, but we don't. So we're looking at those, truly exceptional deals that make it through our underwriting process. Okay, I'm going to move on to one last point, because this was another question I had. Is the market different in this world, the QOZ 3 world, than QOZ 1 or 2? And the answer is yes. It's different, and it's better for you. And I'm saying this, I'm an investor in QOZ 1 and QOZ 2, and those funds are going to do well. But this fund is benefiting from the fact that we're now underwriting to a 6 cap. Well, a year and a half ago, 2 years ago, you could get a 40% margin underwriting to a 5.2 cap because cap rates at the time were 3.5, 3.6. And I'm being conservative. I mean, the reality is in Nashville and Charlotte and some of the markets that we cover, certainly Austin, certainly Phoenix, the market was more like a 3.25 cap. And we never chased it, but that's where deals were getting done. Now the market is a 4.5 to 4.75 cap because borrowing costs are so much higher, the cap rates follow. So just on a sort of apples to apples basis, QOZ 1 and 2 did a really good job of investing at 5.2, 5.3s when the market really was investing at 4.8, 4.9s. Now we're investing at 6. So like on an objective basis, this isn't worse, it's actually better. You're getting into a higher unlevered yield than you used to. So I'm very excited about this particular vintage fund. I think it has a great opportunity to generate really high returns. Okay, so I'm going to move on to another question. And Kyle, generally, I'm going to send you the deal level stuff and I'll cover the fund level stuff. This is a great one for you. It's anonymous. Have all the assets of Fund III been identified?
So you saw the pipeline, we've had about 6 opportunities on there. Those are all pipelines that were either in active discussions for doing the opportunity with those partners or providing feedback on what would have to happen, as we noted in those 2 case examples, to meet our internal cost of capital. And the other opportunities, we're working through the existing underwriting we have received with them and sup with the sponsors. So like, there's a few examples in Florida. Florida has a Live Local Act, and we're talking about how we can potentially realize savings via that. So we have opportunities there. I think there was 260 million in equity. The fund is 300 million. That would assume you do every deal. There's a pipeline. We have to work through our standard due diligence process internally to get comfortable with underwriting and then ultimately reach a deal with the sponsor. But outside of those deals we've shown, we're, the deal team, myself and our respective colleagues in our markets, we're working on another 10 to 20 opportunities that may be a viable fit as well. And so most of the opportunities have been identified. Now it's just working through and getting the right deals that pass our lens of underwriting.
Robert, thank you for your question. He has a question about deferred capital gains. So let me take you through this in detail. So when you invest in a qualified opportunity zone, you don't have to pay the capital gain on the initial investment. So let's make it very real. You have a stock that you have $1 million gain on. If you don't invest that in an opportunity zone, then the following year, you'll have to pay roughly 20 to 23% at the cap gain rate on that gain. So $230,000 would be due. If you invest in an opportunity zone fund, you don't have to pay it the next year. It's payable, 2026 taxes payable in 27. So like per the letter of the law, it's December 31st, 2026, but that's not payable until 2027. That's the deferral of the original capital gain. You still have to pay it, but you get to hold that money, and right now it can accumulate risk-free at 5%, or you can choose to invest it, but it's still due. It's just you get it, you get to power your money for 3 years roughly. I hope I'm being clear. And then of course, the next investment in the qualified opportunity zone asset itself is not taxed at all. So that's the next benefit. But you do have to eventually pay your original capital gain. It's just deferred for 3 years. So if I'm not clear, please email me and we'll talk offline. I know that you're on a lot of these webinars and I appreciate your partnership, Robert. Okay, next question. I'm going to answer this too because it's about catch-up, Kyle. So this is anonymous. Can you explain what a 50-50 catch-up is? So the way I would explain a catch-up is this. If people are familiar with hedge funds charge a management fee and a promote. And so they say, okay, it's just for argument's sake, it's 2 and 20. Everyone's heard that. That means they charge you 2% a year and they take 20% of the first dollar made in profits, right? So if that hedge fund makes $1, they take 20 cents, you take 80. In a private equity fund, certainly in ours, we pay you what's called a preferred return. And so what that means is we don't split profits at all until you at least get 6% on your money. And that's true in this fund. So if we can't deliver 6% on your money a year and it compounds, then we don't get paid anything. So if in 10 years we've averaged 6% or less, then we get no promote at all. Versus a hedge fund, they would take 20% of whatever was made, whether it was 2%, 3%, 4%, 5%, they're going to get theirs. We don't. We're saying we don't get 6, we get nothing. However, if we do get 6, then we're saying eventually we need to take 15% of the profits of what's done. So if we're at the end of the day, if we get 12 net, like we hope, which by the way is an enormous return over that period of time. Wealth is created with compounding IRRs over time. It's very different having a 10-year IRR of 12% or a 30 IRR over a year. There's no money in that. You've made almost no money. 12% over 10, you're making a lot of money. How much? 2.2 to 2.5 multiple on your money, real wealth. If we're able to do that, we share 15% of the total profits. The only way to get to 15% of the total profits, we need to be caught up with the 6% you already made and we didn't share it. So for the next 1%, we're going to get a 50-50 catch up until we're caught up, and then it's split 85-15, 85 to you, 15 to us. This is not a concept that's unique to this fund. This is very, very common in private equity. Sometimes it's 100% catch up, sometimes it's 50-50, but 50-50 is more friendly to you because 100 means we take all of the profits until we're caught up with your 6. Here, we're sharing with you 50-50. So again, David at origininvestments.com if you have questions. My big kind of challenge with hedge funds in general, they should be required to have a preferred return. We do, and you benefit from it as the investor. Hedge funds should too. They should have a minimum return that you should get before they share in their profits, and they don't. And so this is a better structure for you. Okay, next slide, next question. So what, Kyle?
Now go ahead. I don't know if you have.
A question anonymous about replacement costs. This is relative to high-rise deals in Dallas. And generally, I think his question is, where are assets trading relative to replacement costs? Here, he's being told they're trading at a deep discount to replacement cost. Would like to hear your thoughts on development versus buying existing assets below replacement cost. And I will say this: high-rise construction. It could be that this developer got kind of caught in really high building costs and then a move in cap rates, interest rates, et cetera. I'm not sure, but generally we've seen two things, and Kyle, I'll defer to you in a moment. 2 years ago, everything was trading above replacement costs, and that made no sense to us. It was 20-30% of replacement costs when you bought a new building. Now, admittedly, you're in an inflationary environment, so that explains some of it. But we also just believed that that was not a good idea to invest in new buildings that were trading above replacement costs, so we didn't. We actually haven't bought a building in 3.5 years for that reason, which is a pretty extraordinary statement for a company with billions and billions of multifamily real estate. We haven't bought it since 2020. Now we are seeing that it's not trading above replacement costs. And in certain instances, it's approaching replacement cost or slightly below. I certainly haven't seen anything at 40% below replacement cost, but I'll defer to you, Kyle.
Yeah, I haven't seen anything yet at 40% below replacement cost. I mean, when you look at type 1, that's a type of construction, high rises that we look to avoid. But in the last 2 years, concrete is up 21% overall, which is the main component. And then if you look at the main product that we build, garden product or townhome product, lumber conversely is down 33%. And so we like where we're positioned in these developments and the overall basis relative. Also, one of the other things we're seeing generally in Texas, no deal really makes sense from a return perspective unless you have some kind of tax benefit via PFCs. And so that's something we'll watch, something that could interest us back in the acquisition market.
Okay, Frank, great question. Thanks for your question. And thanks for your partnership, Frank, and QOZ Fund II. His question is, will Fund III joint venture with Fund II on deals because he's gauging his combined exposure? Yes and no. It won't joint venture with Fund II, but it is possible that Fund III will be the sole equity on a subsequent phase. Like, so I'll give you an example. Kyle mentioned our deal in Nashville, Edge Hill. That's entitled for 720 units. We won't build that all in one phase. It's too many units to build and absorb in one phase. So it's possible that Fund 2 would do the equity and the investment on phase 1, and Fund 3 would do the equity investment on phase 2, both on the same site. But they won't be co-investing with each other in one phase. And similarly, we have a project in Noda. These are generational land sites. You can't get sites like these. This is land we bought in 2018. So here, QOZ 1 is going to do phase 1. QOZ 2 is probably going to do phase 2, and QOZ 3 might do phase 3. But they're all unique and independent of each other. So great question, and I hope I answered that. Again, David at Origin Investments, if you want to talk offline. Question about development partners. What untrended yield are we targeting for new opportunities? I covered that. Generally 6%. I mean, that's what we're looking at. But I can tell you, our 6% untrended yield, and we call it return on cost, but same idea. Our underwriting is quite stringent. We are using cost inputs. We are using our own multilytics. We are using a rigor that maybe some of our competitors, they would tell you that's a 6.5, but to us, it's not. It's a 6. Like our 6 is a pretty conservative 6. In addition to that, because it sounds like you're in the industry, we don't trend. We do trend cap rates higher in our model. So it has to withstand a 10% increase in cap rates over 5 years and still produce the required return. Now, as we sit today, no one knows what cap rates will be in 5 years. But in every model we have, we're assuming they'll be 10% higher. Will they? I don't know, but the 6 becomes a 6.5 pretty quickly, right, in our world. And that's another reason if you're in QZ 1 and 2, and you're thinking, well, all these things change, you know, why are the returns still hanging in there and they're still good? It's because we're so conservative in what we undertake that now you've seen a shock. So, you know, Frank, if you're in QZ 2, you've seen a shock. You know, the capitalization rates did go up. The borrowing costs did go up. Why is it that I still feel so good about the fund? It's because we were so conservative about the underwriting and we choose the highest margin deals. And that's what protects and grows your money. I hope that answers your question.
I think the other two components there is our colleague Mark Turner wrote a great piece on market insights on insurance. And so today that 6.5 cap from our partner, that might be a 5.75 in our underwriting, is actually reflecting higher insurance costs and higher tax load, which may be why you're seeing the high rises in Dallas incur at a steep sale of a discount as well.
Kyle, did you on your slide cover the 3 Colorado Spring deals that we did?
I touched on briefly about how the city of Colorado Springs had up to 2,000 units, and we were able to be the benefit for the projects there to get a 75% tax abatement for 15 years as being part of that program.
Yeah, and that's the big theme here is the OZ, it's a great benefit for sure. It'd be very difficult for you to find a better tax efficiency than what exists here, but you still have to make money. And so when we're looking at deals, oftentimes, like number one, we want it to be in a high demand city. Colorado Springs is growing incredibly fast. There's high demand, but they're also incredibly underhoused. And so the city has been incenting developers to build housing because they need it. And they're phasing it out now. I mean, the incentives we have are now being phased out, but to get 75% tax reduction for 15 years, I mean, that's your largest expense. And, you know, three-fourths of it isn't being paid at all. So these are the deals that excite us because they produce that last 10% margin that to us is everything. You know, it's not getting 30, it's getting 40. Or today, it's not getting 25, it's getting 35. Next question, this is anonymous. Are there penalties or consequences for withdrawing funds from a QOZ before the 10-year hold? Yes, and it's something you should really think about. If you withdraw, and you can, you will lose all the tax benefits. And you will need to pay your original tax that you're deferring the following year. So both things happen, the two benefits, and I talked about before, deferral and then elimination of the new tax, they both go away. And so it's something that it's an incredible program. And if you pair it with the right management and strategy, it can really be a great part of your investment strategy. But it's a liquid, and you need to be aware of it's a 10-year commitment. You don't really want to change your mind in year 4. It's not a good idea. The last question I see is about sidecar opportunities. And you're welcome to answer that. It's just, do we envision sidecar opportunities in Fund 3 like QOZ Fund 1 had?
That's always a possibility depending on the attractiveness of the deal and the overall deal size for fund allocation of equity. And so that's something that could exist. We're not going to guarantee that's going to exist, but depending on the deal and the overall exposure and percent of the fund, that is something that could be opened up with opportunities.
Yeah, I agree, Kyle. We can't guarantee anything, but I think it's likely. I think it's likely there will be a sidecar opportunity in this fund. Simply, we want to have a diversified portfolio, and some of these deals require equity that would be too much concentration in one deal. And then that's why we offer sidecars, period, is, if the fund's 300 million and a certain deal requires 45 million, we believe that's too much exposure. Even if we love the deal, we don't want the fund to have 15% exposure in one deal. And so I think it's highly likely that happens. And what winds up happening is if we have a sidecar, the first look goes to that fund, specifically those investors. And then if those investors want it all, then it's filled completely by that fund group. We are 3 minutes over, but I thought we got through pretty well. I didn't even tell the story about me and you playing basketball, so I'll leave that for the next one. But Kyle, thank you so much for joining us. I know how busy you are. And again, if people have questions not answered or not answered in totality to your satisfaction, David@origininvestments.com. We're committed to answer every question. Thank you for your partnership. If you're a partner and if you're considering entering the QOZ space, please consider us as a viable option. Have a good day.